we acquired it. And, at that point, it was ours. And our repositioning, what really started to get me excited at that point was as we repositioned that asset, there was a hoarder in it. The rents hadn't been updated, increased in years. The day we acquired it, there was an eviction. 3 days after we closed, we found out that one of the units was, the owner's brother-in-law or uncle or something, and they moved out. So like within 72 hours of us acquiring this property, we had 37% vacancy. It was atrocious. But as we repositioned it, we fell in love with the fact that it was our thumbprint on the asset. How we rehab the units, the flooring, the paint, the attention to detail, the choice of countertops. Mike is very much a design type guy. We call it the Turkel finish out. And when it kind of increased our pride of ownership. And I think that is really kind of what continued to grow our affinity and passion for this business.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network CREPN Radio. Thanks for joining us. My name is J. Darren Gross. This is a podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Matt Buchalski. Matt is a serial business builder, sales leader, and multifamily investor with nearly 2 decades of experience. And in just a minute, we're going to speak with Matt Buchalski about strategies for establishing quality returns and passive income in commercial real estate investing. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Matt Buchalski. Welcome to CREPN Radio.
Thank you so much, Darren. Thanks for having me on the show. I'm excited about this.
I'm looking forward to it as well. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure. So my name is Matt Buchalski. I have been in sales now for very quickly coming up on 30 years, which is absolutely crazy to say out loud. But I've been in sales my entire career, sales leadership for most of it. And I love the idea of helping people become the best version of themselves. Building businesses. I'm currently on my 3rd or 4th cold start on launching a sales team. And I'm a dad of 2 amazing kids and a 3rd little girl who will soon be my stepdaughter. I'm engaged to a wonderful woman. We're going to be married here in just a few months. And I love to invest in things and generate returns for both myself and my investors. So no shortage of time and no shortage of demands on good old dad around the house.
That's awesome. Well, congrats on all your good fortune there. That's awesome.
Thank you.
So Matt, let's talk a little bit. The topic about passive investing in that. Tell us a little bit about how you are investing in real estate and what your role is in your investing ventures.
Yeah, so I started investing in real estate 9 years ago, almost to the day. I think I bought my first one in April of 2016. And I was on a fishing trip with a buddy of mine who owned a bunch of single family homes out on the east end of Long Island. And he walked me through his formula and opened a bunch of doors for me afterwards. And I'll always be very, very thankful to Pete. He's not doing well health wise right now. So my prayers go out to you, Pete. I know you're going to get through this. So once I bought my first one and saw that it was so easy to be overcome many of my limiting beliefs, the bug hit me. I bought my second property 3 months after the first one. I bought my first I bought my first multifamily property 6 months, 7 months after that. And it's just been this steady stream of, acquiring properties, stabilizing them, and then moving on to the next one. And so, over the course of the last 8 years, I've accumulated, 200 multifamily units, 100 RV storage, and I'm either the, GP or deal sponsor on those or the direct owner.
Got it. So, but when you started, you were buying single families, is that right?
When I started, I was buying single families, and, you know, it was what I was exposed to at the time. The concept of owning real estate was always very interesting to me. I just didn't know where to get started. And I cut my teeth on not just single family, but lower end single family homes with Section 8 tenants. And, it's funny because I think getting started in Section 8 for a busy professional who's trying to find their way into the market is a great way to do it because you kind of eliminate a bunch of variables around how am I going to collect rent and where am I going to find great tenants and so on and so forth. And the answers to those problems are actually way easier to solve than kind of jumping into market tenants where you have no idea what you're doing. And we still have a percentage of our portfolio with folks on housing vouchers today.
Yeah, no, I have a similar path with the initial property and Section 8. I thought it was a great formula for like I said, a landlord. And like I said, the rent was never in question. There
Yeah.
was a guarantee, and plus there was an extra added benefit of the inspection process. I think there was a, a, a level of compliance fear with the tenant that if they screwed it up, they were going to lose it. So they were. I felt like at least the tenant I had was a model tenant. I mean, they wanted to keep the benefit they were receiving. Uh, raised a family. It was a good program for myself.
I couldn't agree more with that. And it's my mentor always told me, he's like, it's easier to get kicked off the program than to get on the program. And over the course of the last 9 years or so, I've had one bad tenant on housing voucher. And when push came to shove, like the caseworker was 100% on our side and supported us in getting that resident out. You need to be detail oriented and you need to screen your residents. And if you're able to do those two things, you're going to have a lot of success with Section 8. And to your point, there's nothing better, especially as a commission sales leader, right? To get my commission check on the 30th or 31st of every month. And then come hell or high water, that direct deposit hits from DHA or whatever other housing agencies on the first every month like clockwork. It's nothing better than getting paid multiple times a month.
Yeah, amen to that. So sounds like your fishing trip, you caught the bug, you jumped in, and in relatively short order, you were a landlord with multiple units. So you had a couple of single families, got into the multifamilies,
Yeah.
and so what was it that originally appealed to you that really caused you to say, I'm going to do this?
Once I got the first one under my belt and, you know, figured out that a lot of the reservations were really in my head and that I had the network and I had the time and I had the resources to invest more heavily into real estate. I never looked back. I think there was probably a little bit of, I don't want to say hesitation, but definitely some additional questions that I asked myself when I thought about, moving on my first multifamily property. But then when you break it down, it's like, yeah, you can go buy an 8 unit and it sounds a lot different. But if you treat it like you're just buying 8 separate units that happen to be contiguous, then you start to decode the kind of the fear set. And so, I had made a blind offer on an 8 unit here in Arlington, Texas, and uh, I was kind of on the birthday party circuit with another guy who, we're still in a partnership now, but our kids went to the same school. He said he wanted to do real estate. We went out to lunch a couple times. I made an offer on this 8 unit thinking I could take it down myself. And then I listened to an episode of Bigger Pockets, and I remember Brandon saying, 50% of a deal is better than 100% of no deal. So I called Mike up, we got on the phone, we underwrote this deal. Took us 2 weeks, and doesn't take us 2 weeks now, but it took us 2 weeks, and we figured out, we got comfortable with it, we acquired it. And, at that point, it was ours, and our repositioning. What really started to get me excited at that point was as we repositioned that asset, there was a hoarder in it. The rents hadn't been updated, increased in years. The day we acquired it, there was an eviction. 3 days after we closed, we found out that one of the units was, the owner's brother-in-law or uncle or something, and they moved out. So like within 72 hours of us acquiring this property, we had 37% vacancy. It was atrocious. But as we repositioned it, we fell in love with the fact that it was our thumbprint on the asset. How we rehab the units, the flooring, the paint, the attention to detail, the choice of countertops. Mike is very much a design type guy. We call it the Turkel finish out. And when it kind of increased our pride of ownership. And I think that is really kind of what continued to grow our affinity and passion for this business.
So prior to real estate, you mentioned you've been in sales, always been a commission salesperson. Is that right?
That's right.
So in sales, it's always exciting to get paid. You make the sale and get paid. Uh, but what did you see with real estate? Was there anything bigger or any kind of a other than like you mentioned earlier about the guarantee rent with the Section 8? Was there something a bigger goal that you had in mind?
That's a great question. And yes, and right around, 2015, 2016, I was having kind of this internal conflict with myself. I had grown a number of businesses, several of which from the ground up, and I realized I had made the owners of those companies a lot of money, right? And I thought to myself, well, if I can do that for them, how do I do this for myself? And so I kind of went on this quest, and I looked at franchises, and I looked at opening, various kinds of businesses. And you're hanging out with your friends at the bar, and somebody has a great idea about a business, and they always just really fizzled. And then real estate came into my purview, back to that fishing trip. And I was like, you know what? It's an asset. It's not going anywhere. It's manageable. If something breaks, you fix it. You charge rent. You pay yourself, if you end up paying the house off or the property off, and you keep what's left over. And I just got really, really excited about it. And for me, it wasn't buying real estate, it was building a business for myself through the acquisition of real estate. And then as I started to get more and more confident and more comfortable, it transformed once again into how do I leverage my skills and talents as an operator and start to raise money through, 506Bs and 506Cs and syndications, and start to generate returns for others. And from a sales leadership perspective, I think it's my job to hire and cultivate the best talent around me and help them become the best, possible versions of themselves. But from an entrepreneurial perspective, like it's my job to not just raise money from investors, but deliver returns. And that it's very interesting how similar those two kind of frameworks and perspectives are. But that's what really, really got me excited. And when that clicked for me, that's when things really started to skyrocket.
Yeah, no, I'm hearing you, and I would love to kind of hear more about, that it's one thing to buy it and own it, and even like with you have a partner, it's a one-to-one. You guys made the decision together to go buy, like you said, you can put your thumbprint, fingerprint on the property, and you have that pride of ownership. You can drive by, collect rent, all the numbers uh, makes sense. But making that I want to say a leap from buying your own properties to then raising capital from others and going large with syndication. Uh, can you walk us a little bit more through that as far as the mindset from you knew it was working and then how you made the decision to go again with the syndication, maybe we should start with what's your role in the syndications that you're participating in.
Yeah, so I'm a GP, a deal sponsor. My name's on every loan. I help with asset management. I am the lead underwriter on opportunities that we are evaluating. So I wear a number of different hats, as many folks, in the kind of GP world do. Um, yeah,
Okay.
I Mike and I. We're fantastic partners and great friends. We've been on vacation. Our families spend time with one another, but we're polar opposites when it comes to many things, right? He is he's an engineer by trade, right? He builds incredible software programs and manages very large global teams in that field. Is super detail oriented, and in some ways, it's his job to find things that are broken and find things that are going to go wrong or things that are wrong. And me, I'm kind of the heads down, bulldog sales guy. Like, put a barrier or a roadblock in front of me, I'm going to go over, around it, underneath it, or through it. And so we complement each other's skill sets in that regard. Um, but we got to a point where we were acquiring assets and we wanted to make the jump into just doing bigger deals. And once we had stabilized that 8 unit, and I mean, we were getting, $200 a month per door profit per month. And so we were just seeing kind of our operating reserve account, grow and grow and grow. And we needed to find the answer to the question, how do you scale? And we had looked at a couple of larger deals, didn't really have the confidence to do it. And so we made the decision to join a mastermind group. And we had evaluated several mastermind groups, talked to the kind of figureheads of each one, and we landed on the Jake and Gino community. Um, their family focus and not using the coaching program as a profit center and reinvesting their proceeds into events and conferences. And Gino shows up with his family at these things, and Jake doesn't show up at all of them, but when he shows up, like, he's got a purpose for being there. Like, that community really resonated with us, and literally within the first group or the first weekend retreat or workshop or whatever you're going to call it that we went to, we made our first offer on a larger scale property, and we ended up acquiring that property. And then we when right after we had closed on that one, we bought the one next door. So it's like the power of proximity, the power of being able to nudge the guy next to you when you're sitting in a group of other investors and say, hey, how do you handle this? Or do you have experience with this? And then them having the answer, or knowing someone in the chair next to them has the answer. That to us was very, very powerful. And we still delve into that group for expertise. We're still members in the group. I think we have a meeting here in Dallas here in the next couple of months. But I think surrounding yourself with people that have done it before, being in a place where other people are intentionally they're willing to share information, really shortens the ramp to success, and provides a lot of resources on how to accelerate.
No, that's awesome. I appreciate you sharing that. Big fan of Jake and Gino. I've had them on here a couple of times. And they've just been like I said, a very giving wealth of information. I've had some just one-on-one conversations with Gino as well when I was buying a multifamily. So I concur and agree and applaud you for finding those guys. They're great.
Thank you. And it's funny because so we went to our first mixer that we went to, and I think it was Knoxville, Tennessee, where they have, the vast majority of their portfolio. This is our first mixer. We were all excited about it. It was Saturday, and all the guys, it was at the end of the day, 5 o'clock, and everybody's like, let's go for drinks, let's go for dinner, we're gonna go out. And I'm like, Gino, you want to join us for a drink? And he's like, no, I'm taking my family to church. I'm like, there's a guy that values and family time is super important, and like that one statement I'll never forget, and just really cemented how values based guy he and his team are.
Yeah, no, amen to that. So you your initial strategy, you start out alone, you partner with Mike, you're buying properties. The initial strategy, was it buy and hold, or were you looking
Yes.
to? Okay,
Yeah, we had done a flip. We had actually done two flips along the way. This is when flipping was like super cool to do, and every Bigger Pockets episode was somebody that started off with nothing and was doing 100 flips a year. So we tried our hand at flips, and we're two busy guys, and like there was just no way to micromanage the contractor and make sure the project was done on time. And on our second flip, we had a contractor steal some money from us and like not finish the job. And Mike was pretty defeated about it. And I just wouldn't give up. And so I chased this contractor down. I called his wife, ultimately got our money back, and pivoted, hired somebody we knew to finish the project. We sold it, we made a little bit of money, and we looked at each other and said, no more flips. We're sticking to what we know scales and what we feel more comfortable with, and never look back. I never even thought about doing another flip after that.
got it. So when you go into these syndications, how do you view those? Because in a sense, when you pool everybody together, are you presenting it as a long-term investment, or is there more of a, I don't want to say flip, but just the nature of it when you pool everybody together and then eventually people want their money back, there is an exit on the horizon typically. Tell me a little bit about your guys' strategy on the syndications you've done.
Yeah, so I think the strategy we had is probably not the strategy that we have now, but where it was is we were setting 5-year exit plans on the assets that we syndicated. And earlier on, 2020, 2021, we were definitely focused on more C class, value add type opportunities. And so, again, Mike's probably way smarter than me. One of us is smart, one of us is handsome. We still don't know who's who yet. But like, we figure if we're going to go raise money, how do we eliminate or reduce variables? So I told you about that 8 unit that we acquired together. We had sold that property in the summer of 2021, right around the time I met my fiance, as a matter of fact. And then we found more properties in Arlington that looked very similar to the 8 unit that we had acquired and been very successful with. It was in an area that we knew. We knew the rents, we knew the tenant profile. And so when you're going to go raise money from people, right, it's your name on the OM, right? And so we wanted to be able to say that we had credibility and previous success in the area, right? We could have gone anywhere else in the DFW Metroplex and tried to do our first syndication, but it made more sense for us to do it where we had history, we had a network of people, we knew the residents, we knew the rents, and then this way, as investors start to ask you questions, and you say, "I don't know," like how credible are you as someone that is going to raise money? You're going to ask somebody for 50, 100, several $100,000, you better be ready to answer their questions. And it becomes a lot easier when you not only have an answer to their questions, but you have experience doing similar things in very similar areas. So that's where we started, and now we have 4 communities inside a 3-mile radius, 3 of which were syndications.
Oh, that's great. And do you are you vertically integrated? Do you manage or do you have a third party manager? How do you operate the
Yeah.
properties?
Um, no, we have an outside third-party management company. Third-party management, I think, is something that has really shown its true colors here over the course of the last 2 years in this part of the market cycle. So I think in the, you know, early, mid to latter stages of COVID, as we had this ZERP phenomenon where people were just out there spending money and landlords were raising rents and, people were just spending haphazardly. It was easy to be a third party manager because there was a lot of demand. People were willing to spend the extra money, et cetera, et cetera. And this was prior to inflation. So costs, while rents were going up, costs were staying relatively the same. So you look at genius. And it was easy to look really, really good during that time. This environment's a lot different where, residents are a lot more conservative with their pocketbooks lately. The cost of operating expenses have gone up. And, with all this new supply coming into the market, occupancy is a little bit tougher now than it was before. So, yes, we third party manage. You kind of pulled the string on me there, Darren. And my guidance to anyone out there is make sure you have someone, make sure you have a third party property management team that has adequate resources to support your portfolio, experience in both sides of the market cycle, and a depth of tools and strategies to keep your properties performing as best as possible.
Yeah, well said. I know I've got multiple third party managers and kind of the rainbow of experiences. I mean, I think for me inherently, there's if I trust them, I'm on a good starting point, and I can say that all the ones I currently use, I do trust. Um, when I feel like the job is not just collecting rents and providing the income statements and depositing the check. It's about keeping the property. One property manager I talked with, he said, my job is to make sure that property is ready to sell at any time, meaning like keep it operating at a peak level so that if you call me, and you decide to want to sell, there's no like heavy lifting, like, oh, we need to do this, we need to do that. It's ready. And I thought that was pretty insightful. Um, to have somebody with that kind of attention to it, or just even that foresight, recognizing that these properties trade on a regular basis, and if you want to continue to be the manager of the property, do a good job for the one, your current client, and you can maybe become the next, owner's manager as well. But yeah, I don't know what kind of experience have you had to go through the change out of management companies, or have you been pretty successful with, or pretty fortunate to have the same management companies?
No, we've had to actually go through the change of management companies a couple of times. And it's a painful process, right? You have the kind of relationship management piece with any new expectation setting with the residents, which I think is probably the most difficult part. Anyone can take down one payment portal and put up another payment portal, but really taking the proper empathetic human to human approach and building trusted relationships with residents, that takes time. And if you have a gap in coverage, it takes that much longer for residents to keep up with that change. So we have very little tolerance for substandard performance from our third-party managers. I'm a sales leader by nature, so I thrive on KPIs. I thrive on accountability, not just for me, but again, it's my name on the OM, and it's our job to deliver returns for our investors. And when you can only give so much rope, and sometimes people run out of rope, and you have to make a switch.
So tell me the size of the properties you've got. You said you've got four and somewhere around 200 units or of
So
the
we have four
syndications.
assets in Arlington.
Okay.
We have one in Garland. We have one in Waco. We have a storage facility in Cleburne. So we're really, focused on north and into central Texas.
Okay. Okay. No, that's a lot, and you know, I can't imagine doing that without third party management or having, management because I'm assuming when the first property you talked about, did you manage your first single family yourself?
Yeah, so I managed my first single family, which was in New York from Texas. This was
Wow.
2 years after I moved here. I managed my second single family, which was here in Garland, Texas, up until a year ago. Um, and our first 8 unit, which we acquired in 2017 and sold in 2021, we self-managed that. And that was talk about cutting your teeth between the hoarder and the evictions and all kinds of stuff. Like there was a couple times where we scratched our head, but we learned lessons on that will forever shape our investment thesis and how we handle things. But I will say, and I'm very proud of this, and I've talked to Mike about this over drinks a number of times. I was the guy that was responsible for collecting rent at that 8 unit, and I went 3.5 years without a miss. And the only reason I broke that streak was because of our one Section 8 tenant, the only one we've ever had a problem with, had a fight with her boyfriend. He kicked the front door in, damaged the property. We had to kick her out. But before that, through COVID, mind you, nobody ever didn't pay rent.
Wow. Pretty impressive record, especially through COVID. I
Yeah.
wish I could say I was the same. Um, so let's talk a little bit about some of the strategies you guys when you're acquiring properties and maybe we've talked or hinted at a little bit about just kind of the change in the market cycle. So maybe you could walk us through what the properties you have now, what you kind of what your buy box was
Hmm.
versus what you're seeing today and potentially here in the near future.
Yeah. So going back to 2020, 2021, we were definitely uh, most attracted to C-class value add assets, under market rents, some CapEx that would need to be done to get the properties up to their full potential. And it worked at the time. The problem is that in that part of the market cycle or in the run up to the peak, right? At some point, property taxes and insurance caught up with the market. And fast forward to 2023, when all these enormous new assessments came out, you could have a property that's performing great, but you can't control your property taxes or your insurance. And there was a huge reset on premiums and assessments in 2023, which really kind of put the pinch on some of those deals. And then if you think about it from an economic perspective, depending on whether you talk to me or you talk to an economist, right? An economist's going to tell you that, recession requires 3/4 of negative GDP growth. I'm going to say that we're very much in a silent recession right now. And the workforce housing and the types of deals that we were attracted to a few years ago are seeing enormous amounts of fraud. They're seeing, flat to negative rent growth. They're being impacted by the amount of new supply coming on the market and the incentives that that new supply carries with it. And that's kind of trickling down and enabling people to move from C-class assets to B-class assets or B-class assets to A-class assets. So this whole ecosystem has definitely gone through a pretty significant adjustment. Uh, we were underwriting at insurance at $600 or $700 a door. Back in 2020, 2021, we were underwriting for anywhere between 85 and 95% of the purchase price and the times the mills rate on property taxes, depending on which counties we were buying in. And now, like we just did a refi a couple of months ago. I think we paid 1,300 a door on insurance, right? And so right there, you're at twice the cost that you underwrote for, right? And even if you raised it 3 or 4% a year, even 5% a year, you're still at 100% expense growth in the first 2 years of your hold period, which, puts a pretty significant crimp on returns and the ability to deliver them for your investors. So based on all that, right, we've adjusted our, property tax underwriting criteria, our insurance underwriting criteria, CapEx reserves, occupancy, vacancy. We've increased on economic, our allowances on economic occupancy, either for bad debt or whatever. But most importantly is we're now focused really on going more upstream and into A minus, B plus type properties. And we've definitely looked at our fair share. The difference is though, um, there was a lot of building done in the 60s, 70s, and 80s, at least here in Texas. There wasn't a whole lot of new supply that came online in the 90s. And then you jump into the 2000s, between 2000s and now, and you're talking about some of these larger, gated communities, lots of amenities, pools, gyms, etc. And these are multi-hundred unit type properties. And, it takes a big jump to go from, 5, 6, $7 million assets to 25, $30 million acquisitions. And we've never really been fans of just adding more GPs into the mix just to get deals done. Because when you have too many cooks in the kitchen, right, nobody's really in charge. So, it's definitely not just the underwriting criteria and the asset change, but also like the ability to scale from a capital raising and asset management perspective. So there's some recalibration that's going on that I don't think a lot of people are talking about.
Yeah. Well, in that, just the market cycle, are you seeing opportunities? We haven't really talked too much about it, but I mean, clearly the financing has changed dramatically in addition to the insurance and taxes.
Mhm.
Um, are you seeing, opportunities where debt's maturing and, you know, prospective properties are available at price resets compared to what they were when they traded last?
Yes, but not as frequently as we thought we would be at this point. We've seen some deals be openly marketed at the loan balance. So the sponsor is willing to walk away from whatever equity they and their investors contributed to the deal, hoping to get out of it for the loan balance. Problem is, right, when deals were being sold at a 3 or 4 cap 3 years ago, and now you can buy them at a 6 cap because of the reset, right? Sometimes even buying it at the loan balance doesn't make sense, right? So
Right.
it's we've gone from, one end of the market cycle where sellers could pretty much ask whatever they wanted for a property, and somebody needed to get a 1031 exchange allocated and was willing to pay a higher price just to avoid the tax consequences, to a situation now where, you know, the 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 earth has shaken and some of those sellers need to get out, but because of how significantly the market's changed, they may be forced to lose money in order to get out and avoid, any more pain.
Yeah. With your syndications that you've done, what are your or have your exit strategies changed from when you originally, um, raised the money and acquired the properties to now? And if so, what kind of response have you received from your investors?
Yeah. So what we've done is actually, you know, on a couple of assets, we've had to extend the hold period, right? We had two assets next door to each other that we refied in November of last year. We had underwritten, I think it was either a 5.5 or a 5.7 interest rate. Uh, and I think we locked in at 5.93 like 2 days before Thanksgiving. So we weren't that far off it just doesn't sound that far off, but when you compound that change over time, and then, we had forecasted a 5.5 exit cap, and, we got to a 6 on the refi. So on the appraisal, I should say. So we can go to our investors and say, things have changed and, it is what it is. Or we can say, and history repeats itself, right? Real estate tends to be very forgiving, right? So we're going to extend the hold period. We may not get to, because we're extending the hold period, we may not get to additional forecasted returns, but because of everything that's going on, if we can still get to the original prescribed returns, and just takes a little longer to get there, we think that's still a victory, uh, especially with given everything that's going on around us.
Yeah. Well, the thing I've always kind of come back to with real estate is like you were saying, it's forgiving. Time, I guess, is the what forgives all the, whatever. I mean, I've bought in the high of the market, I bought in the low of the market, but over time, it's all worked out. It's just a matter of if you have enough runway to wait it out, and so
Yeah.
that's kind of where I see it. And again, if you have to sell in a down market, that's where you're you lose. If you don't have to sell, then just wait till the market changes. And but I know it gets a little more complicated when you have other people's money, and if they're saying, "Hey, I want my money back," makes it a little more challenging. So,
Yeah. And
mm,
I think the thing that's most difficult about being a GP, or one of the things, because there's a lot of different things, is dealing with the emotions around money, right? And if you think about some of the most cataclysmic economic events that have happened in the last 20 years, right? Going back to the dot-com burst of the late 90s, early 2000s, and then the crash of 2008, and what happened at the beginning of COVID and the reset in 2022. If you didn't sell, you didn't get hurt, right? And if you didn't sell, you've probably made a lot more money since then, right? I had friends and family back in 2008 when the market was just absolutely getting tanked. They sold out their 401ks, they sold out all kinds of stuff, and then they weren't able to time the market on the way back up, and they left tens or hundreds of thousands of dollars at that time on the table, which is probably now worth millions. So unless you absolutely have to, right? Don't sell, right? Everything is a cycle. We may never get back to 3.5% mortgages, at least in our generation. But there's a huge difference in the market with rates at 6.5% versus 5.5 or 5.75. And if you're able to wait it out, get this new supply online, get it occupied. People are still looking for new places to live. Humans as animals will never stop wanting to move around. Get good product, get get great property management in there. Keep it properly priced and market it well. You'll be fine. Just, don't do anything out of emotion and don't panic.
well said. Hey, Matt, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker. And as such, I work with my clients to assess risk and determine what to do with the risk.
Mhm.
And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk. If we cannot avoid the risk, we look to see if there's a way we can minimize the risk. And if we're unable to avoid nor minimize the risk, we look to see if we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. It could be your investors, your tenants, the Fed, um, political, whatever it is that you consider to be the biggest risk. And again, for clarification, while I'm an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Matt Buchalski, what is the biggest risk?
I think the biggest risk as an owner slash general partner is reputation risk. And I think reputation risk comes in two different forms, right? Number one is your own personal reputation, right? How do you handle yourself during the hard times? How do you screen opportunities as they come into your inbox and really gauge which ones are worthy of you putting your name, reputation on, and frankly, capital into? Because I put capital into every deal that we do, right? So I think there's reputation risk from that perspective. The other perspective, though, and this is kind of a little further downstream, but the reputation risk of how you run your assets, right? What happens to you and your community ecosystem by putting the wrong resident profile into your units? What happens if you're not screening your residents properly and they throw parties, or they have bad actors that, frequent your communities? Other people are going to want to move out, and other people will move out, and they won't tell you necessarily why in most cases, right? That's your reputation on the line. That's your sign at the edge of that asset that carries, kind of your branding on it. And so you need to make sure that everything that you do on running that asset helps build and enhance the reputation of that asset. Otherwise, it takes a long time to undo that.
Yeah. Well said. Matt, where can listeners go if they'd like to learn more or connect with you?
I'm all over the place. You can find me on social media: Facebook, Instagram, LinkedIn. I'm probably most active on LinkedIn these days, so you can find me at Matt Buchalski. I'm head of sales at Ownwell. You can find my profile pretty easy. You can also email me if you'd like at matt@ownwell.com. Happy to answer any questions. And this has been awesome, Darren. Thank you.
You got it. Well, Matt Buchalski, I cannot say thanks enough for taking the time to talk. I've enjoyed it. I learned a lot, and I look forward to doing it again soon.
Sounds great. Thank you.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.